Two of Australia's biggest banks reported full-year results this week. The numbers gave a valuable insight into how they weathered the worst of the financial crisis and, in fact, whether it's behind us. To tell us more, we have Morningstar Head of Equity Research, Peter Warrens. Peter, welcome.
Thanks, Vicky. Good to be back.
Peter, in a nutshell, how did NAB and ANZ do?
Well, they did very well. I mean, the global financial crisis, we're coming out of that now, and they performed very strongly, operationally, sound results, profitable. Yes, the impairment charges were high, but they're going to start moving down, and so very, very well. Good capital, good liquidity, good shape.
Peter, the charges for bad and doubtful debts were certainly a focal point in these results. Did the banks give any nasty surprises, or did they give any clues as to when these charges might start falling?
Well, Vicky, we always thought that FY09 was going to be the peak of the bad debt cycle, if you like. In other words, the bottom of the credit cycle. And the elevated impairment charges reflect that. No surprises really, although National Bank's second half charges were a little bit higher than expected, and they drifted off from the big ticket and big company names into the SMEs and the higher risk personal loans area. And that's normal in a cycle. Look, I would think that going forward in FY10, these impairment charges will be lower, and then lower going further out.
Did these charges hurt dividends?
Absolutely. I mean, all the four major banks have cut dividends in FY09. You can only pay dividends out of cash, and cash earnings were down, and therefore dividends have to be down. I mean, the pain has got to be equally shared with the customers and the shareholders alike. And so, yes, dividends were cut. Payout ratios around about 70%, which is about right, down a little bit from previous payout ratios. But I would think going forward, that's where the banks will want to hold the payout ratios, around that number, 70%. And so, yes, affected by in credit impairment charges. As they roll off, the dividends will improve as the earnings will improve. And for them to get back to pre-GFC levels, I would suspect not until 2012, 2013 are you going to see dividends back to those pre-GFC levels.
Did the banks provide any clues as to where we are in the credit cycle?
Well, yes, both Mike Smith and Cameron Klein gave indications that the credit cycle has peaked. As far as they're concerned, their asset quality is pretty reasonable. They've provided well and topped up provisions, and I would think that you're going to see some write-backs starting to come through, not in an aggressive way. I think they'll still be cautious and conservative there. But I think the credit cycle has peaked. There may well be some pockets of continued concern, perhaps in the small to medium business area.
Commercial property lending apparently has been an issue. Is that a concern for either bank?
Not so much in Australia. I mean, if they're in the US, definitely, because that commercial property cycle has not bottomed. But in Australia, it seems to have bottomed. They're starting to see some sales of commercial property now in and around the written down book values of AREITs. And so I would think that the liquidity mightn't be great, but I think the values that are now being transacted at is about right, and I think that the worst is well and truly over for commercial property.
NAB Chief Cameron Klein and ANZ Chief Michael Smith both said they were cautiously optimistic, but neither of them gave a concrete outlook for their banks. Why is that, Peter?
We're still in a very, very difficult world economically. I mean, you've got significant problems still in the Northern Hemisphere. In the US and Europe, and these guys are global bankers. I mean, they have got to go to the global market for funds, and North America and Europe is the place they go. So any problems that they have in those markets is going to be impact on the cost of funds that they have got to raise, and that there's not enough capital in Australia for all the banks to be financed here, so they have to go offshore for a significant amount of their debt. Look. Mike Smith indicated that there are good signs out there, particularly we're in the, if you like, the Asian corridor, and we're going to get some blow off from that. But he did say that the Australian economy is still fragile. And fragile is an interesting adjective to use, because we just really don't know how big and how much positive impact the government stimuluses have had, and when they start rolling off, what's going to be left. And so I think that that's why they were cautiously optimistic without giving too definitive guidance.
Peter, what can investors take away from this today?
Well, that the Australian banking system and the big four banks in particular are in excellent shape, well capitalised, high liquidity, very profitable, and will get increasingly more profitable as the credit impairment charges roll out over the next 2 or 3 years.
Peter, thanks for joining us today.
Pleasure, Vicky.